Welcome to Massive Passive Cash Flow, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Welcome back to the Massive Passive Cash Flow podcast. This is Gary Wilson, your host. We're glad to have you back. Hey, if you haven't done so and you like the podcast, if you could please go ahead and subscribe to it. It's on 30 different channels, including your favorites, Stitcher, iTunes, and iHeartRadio. And while you're online doing that, go to globalinvestoragent.com. It's a website we just created to showcase all the investor agents around the U.S. and Canada too. These are agents that are not traditional, typical agents. They are trained to work with you and I, the investor. They have access to every single parcel in the United States. Doesn't matter how big or small, how tall. Every single parcel, I mean literally loan information, tax information, all the property information. They know how to identify, analyze, and negotiate on and off market deals. So these are critical members of your team. You definitely want to take advantage of it. Click on profile, search by name, search by state, search by city, and grab yourself one of those guys. So in any case, let's get to the podcast. We got Toby Mathis today. So Toby, first off, thank you very much for doing this. I know you're a busy guy, and we're glad to have you,
Hey, thanks for having me. Always enjoy talking to other investors.
You got it. And if you wouldn't mind, would you mind giving people a little bit of intel? You may have to change the names to protect the innocent, but a little bit of background, where you are, how you got there, and then let's go ahead and from there we'll jump into some meat and potatoes.
Absolutely, Gary. So I'm a tax attorney by trade. Got I think it's 25 years in. Work as a principal in a firm that has about 450 employees. We just work with investors all over the country doing tax asset protection and legacy planning. One of our side projects is infinity investing, which is really to help people make more money, keep them away from kind of the really bad information out there and the gurus that, there's a lot of gurus that go out and teach you how to lose your money. And we kind of see underneath their skirts quite often because we do 10,000 plus investor tax returns. So we know who's making money and who's not. We can kind of figure out over the years what's the most consistent way to make the money and how to keep yourself safe and how to do it without spending too much time. Love doing what we do. And that's my background. I'm an avid real estate investor with over 300 properties myself. And yes, I just happen to be a tax attorney to boot. And I just love working with folks that are actually investors. And I think that most investors, when they deal with professionals, should deal with professionals that actually do what they do. Makes life a lot simpler.
Nice. Well, I appreciate that. And we definitely value your experience and background. That's awesome. And what's interesting, the first subject I want to talk about is the banking. My professional career, I was a banker. I did mergers and acquisitions, and I learned to never borrow from the big banks because they were basically it was a big factory line. It was kind of a ripoff, is what it was. So jokingly, I can say this now because I've been out of it for 20 years. This next summer, we call them Banksters. But if you wouldn't mind, would you mind talking a little bit about that? Like why, how is it they could be ripping us off, and why it's not such a good deal? The banks and the media both combined, it just steers people down a certain road, and there's so many other roads that are so much more profitable.
I think it's absolutely horrific what they've done to the millennials, first off. So if you want to talk about bankers, you have to look at all sort of lending that they do. And what they do is they get you hooked on lending when you're 18 years old and going into college. And that's the first step, is they get you hooked on debt that you can't get rid of. It's non-dischargeable, even in bankruptcy. So these poor folks get in and they're buying something that may not be a great return. And they teach us at a very young age to start relying on bad debt. And it's just a product they're selling. Like, I don't begrudge the banks, but I think Bankster is actually a really good way to put it, because they're focusing on people that are the most susceptible to want what they perceive as easy money, and they don't realize what they're giving up. They're just selling a product. So you go into a bank and you say, what should I be investing in and what should I do? It's invariably, it's going to involve putting money in their institution, and where they give you very little, but they can leverage it multiple times and make a ton of money at it, which isn't in your best interest. And they want you to borrow money in something that's probably not in your interest. You're actually borrowing on a liability most of the time. And so you have two liabilities double stacked, and you don't even realize it until it's too late, until you have a 2008 or a 2000 and 2002, when you have these big economic bursts. And all of a sudden, it's you're in a very precarious position, and it's usually life altering. It's actually quite devastating. So I'm not a big fan of debt in the traditional standpoint. I'm not a big fan of the banks in that they're not fiduciaries. They're not looking out for your best interest. I think that you need to be educated to make sure that you can do things that are in your best interest.
Yeah, I agree 100%. What a lot of people don't realize is big banks, there's two types of lenders in the traditional sense. There's banks that are selling their mortgages and banks that aren't. Those banks we call portfolio lenders. They're keeping the loans in-house for themselves. And consumers often will ask, well, how do they even make money? They're only charging 3 or 4%. What you don't realize is the amortization front loads all the interest, number one. And number two is the banks that are selling mortgages, that means they're not keeping them. They're packaging them up, selling them to Wall Street so that you and I can invest in them through mutual funds, which is another topic we'll get to later. So they're absolutely making hand over fist, and they I'll use the word prey. They prey on people when they're first getting out of high school. I mean, it's insane to give a high school graduate a credit card.
Don't let them drink. It's illegal for them to drink. It should be illegal for them to borrow.
Yeah, absolutely.
You say, hey, you don't have the judgment to do certain things, but we'll let you encumber yourself for the rest of your life. I think it's really interesting right now is the Fed is probably the biggest buyer of those mortgages. I think for the last several years, what do they have on their balance sheet now? About $8 trillion. And I think a big chunk of it, many trillion, is mortgage-backed securities.
Yep. Well, you want to hear something really interesting? Just a quick side note. The entire country of Canada, they do not allow the sale of mortgages they don't have a secondary market for consumers. And yet their market up there has been heated up just like ours has been for a long time. In the last recession, Canada never had a recession. They just kept going right along. It's been insane. Well, a couple of years ago, Canada started buying mortgages so they could free up that capital to be reused. And I'm thinking there's something really something sinister underfoot going on. I don't know what it quite is, but it's not making sense. What they're doing, what they're saying are definitely not in sync with each other. But if we could, let's go ahead and move into, I mentioned that the term mutual fund. Let's first start talking about investors and landlords and how an investor can be their own stock market landlord.
Mm-hmm. Yeah, so mutual funds is interesting because it gets us right back into the old fiduciary game. It's like if you're being sold a mutual fund, chances are it's not necessarily a fiduciary because a mutual fund is about 5 times the expense of an ETF or something. If you invested in yourself and you did your own portfolio, it's even less. It's a fraction. So like when I break down a portfolio for somebody, for example, you might have a $400,000 sitting in a 401k. You might be surprised that the fees attributed to that are actually closer to 18,000, where they're only disclosing a few $1,000s a year fee. There's actually a large expense that they're not legally required to disclose because of the management fee. I mean, it sounds like your guys probably already know all that, and you're looking at it going, Jiminy Christmas. What you don't realize is, I think Forbes did a good study. 4.8% was the average expense. Wow. And what are they disclosing? Probably closer to 1.2 to 1.6. It's ridiculous, some of the portfolios we see. But I mean, that's an aside. That's just because you've educated your responsibility. You've handed it over to somebody else and you said, hey, you manage my stuff, and you expect them to do things in your best interest. You got to work with a fiduciary if you're going to do that. And they're going to charge you not a management fee, but usually a percentage of the assets under management. And that's because they have to do that. And it's usually about 1%, whereas the mutual fund's 4.8. So like it just doesn't make any sense to go do a mutual fund. You can't see into them. You don't know what your risk tolerance is. I've always kind of looked at them and scratched my head. Do an ETF or do managed money.
Yeah. But I agree. There's fees that they will disclose, but there's ones that they don't. And sometimes it's can be pretty dramatic, and it's not a pleasant surprise when you see your. In fact, when I first got into banking, banks were not allowed to participate in the stock market side of the house, because the Glass-Steagall Act that came about in the late 80s. And what happened was banks started getting into all kinds of things, insurance, of course, selling mutual funds and things like that. So when you look at their fees, like you could have here's what I'm getting at. You could have a money market account. This was a classic example. Money market means you should never lose capital, right? And there's no fees. They'll say no fees. It's basically like a bank account. And yet you get your statement at the end of the quarter or the end of the year and you're down $200. Well, how did that happen? And because it says there's no fees, but yet you get charged $200. So perfect example.
That's because it's the type of fee. It might be a statement review. It might be an oversight management fee that you're paying to the institution or to the advisor. Like there's all sorts of, there's soft dollar costs, there's tax drag, there's cash drag, there's all these fun things. Even the cost of the information that they have access to, they may assess on you and not on somebody else.
Yeah.
It's the only way you can do it. I've always found that the only way you do it is you actually get your statement and you get your calculator out and you figure out what your actual return is and you take a look at what they're telling you made. And it's usually quite different. I've had that discussion with many a person and they said, no, I'm making about 5-6%. But when it actually comes down to the math, it's closer to 2%. And they go, oh my gosh, this is crazy. And I'm like, yeah. And it's legal. It's built that way. Nobody can really tell you what a mutual fund is going to cost or what some of these products are going to cost. It's all buried in the small print.
Yeah. So, go ahead. I'm sorry. Yeah.
Oh, I was going to say, you asked about the stock market landlord, though.
Correct. Yeah.
I'll go down a rabbit hole if you let me, but because I'll just start saying, hey, these dang mutual funds, because you see so much of the advertising going into it, and that should clue you in right now. It's like, wait a second, they're advertising to me. It's a product that they are selling, and it may not be in my best interest, just like Kentucky Fried Chicken, right? Maybe I shouldn't be eating it every day. But the stock market landlord is no different than buying real estate. And I always look at it like this. Would you buy real estate and just let it sit vacant, in hope that it goes up? That's probably not the wisest way. Like if you're going to buy real estate, you probably want to rent it out and make money off it. But when we buy stocks, for some reason, a lot of people are just happy buying stocks that you're not getting anything for. They're not paying you out any profit. They're not paying you a dividend. And you're just letting it sit there and you're hoping that it goes up. And so real estate investors get this. And this is why I say landlord is you should be renting out your stock. If I'm going to hold stock, I may as well generate something from it. And that's called a covered call. So we said, realistically, a stock market landlord is nothing more than owning a portfolio that then you write periodic calls against, where you get paid. When you get paid to write the call, you get to keep that money no matter what. If the company goes up, there's a potential that you'd be called out, the same way as if you sold an option on a piece of your real estate. Hey, it's sitting at 200,000. I'll sell somebody an option to buy it from me for 220. Well, it goes up to 240,000 on the market, and they exercise their option. Worst case scenario is you made $20,000 plus you made whatever you sold the option for. In the stock market, it's a little different. There's always a market to buy it back and to sell another a little bit farther out, and we call it rolling out. So you're never really in a position where you have to sell the underlying stock even as it rises. Is you just have to, roll it out a couple times if the stock's running and going up, and then waiting for it to take a little, 1 month break up on its run up. And basically you could always keep the underlying stock, or you could say, great, it ran up. I'm going to sell out. I get to keep my option money that I've been making all along. I get to keep all the dividends that I was receiving all along, and I exit the stock. Either way, you're not just sitting back hoping that a stock is going to go up. And investors that do that are usually at the mercy of somebody else controlling their money, who's getting a management fee regardless, a percentage of your portfolio, or you're paying them to do this, or they're churning your account. And you don't realize that they're giving up at least two other income sources, the dividend and the option. And it's unfortunate. You don't realize it until you've been doing it probably 10, 15 years. And you're like, wait a second, you mean I passed up an extra 10, 20% because of this? You're like, yeah, that's actually what it comes down to.
Yeah. Well, I'll tell you what, let's take it a step further here. So these are some of the pitfalls of traditional investing in the stock market and mutual funds. What is, as far as the average consumer, everybody has debt, but what's the mindset? What are the 1 or 3 or 5 characteristics of the mindsets that keep people shackled in debt? I mean, we touched on it earlier about the getting out of high school, get your first credit card, and by the time you're out of college, you've got you're it's like an imprisonment. I mean,
yeah.
So
there's actually really good studies on this too. So, I know that a lot of your audience is, probably professionals, engineers, doctors, dentists, things like that. What's really interesting is there was a big study of millionaires done. I think it was Hogan over there at the Ramsey Institute, and they did about 10,000 millionaires where they interviewed them. And you realize that the folks that were the most apt to be millionaires were the engineers, accountants, and teachers. Those were the top three. It wasn't lawyers, it wasn't doctors. And what it really came down to is they understood math and they understood being a student a little bit better than others. And they did something very, very important, which is they systematically put in monies into their investments. The biggest difference between the poor and the rich in this country, in my opinion, is that checkup from the neck up. It's that mindset of I'm actually in control of my money. And instead of just, again, either ignoring it or letting somebody else do it for you, whoever you decided to offload it onto, they're actually taking an interest in their own finances. So that's number one. It's just this idea of having control. And number two, it's understanding the difference between an asset and a liability. And it sounds really easy because we always say like, oh, I bought my house. It's my biggest asset. Is it? When you look at it and you really say, what is an asset versus a liability? An asset feeds you. An asset puts money in your pocket on a, either a weekly, monthly, quarterly, annual basis. It's putting money into your bank account that you can spend. You can go buy meals with it. You can pay your rent, or you can pay your mortgage, or you can pay your real estate tax with it. Like there's actually money coming in, so you don't have to sell off the underlying asset. That's actually a huge one of understanding that if it's the opposite, it's putting money out of your pocket. I don't care what you call it. Your house is not an asset if it's not producing income.
Right.
And so you see people get taught, hey, this is an asset. My car is an asset. My RV is an asset. My boat is an asset. My house is my biggest asset. Those are not assets. They're taking money out of your pocket. That's a liability. And if you buy a liability with a liability, meaning if I borrow money to buy something that's costing me money, you have it with one little downturn or one little life event, you could end up in a lot of pain. And we saw that in 2008, 9, and 10. You saw that over and over in history where people get toppled over because they're liability heavy. But I feel like they're getting tricked. I think that, again, as you're growing up and you're being told these things as though they're truths, you don't understand that you're passing up assets on your way to, and you're fighting to buy liabilities. You see a young person who gets their first good job and they're not investing anything into actual assets. They're not building up a retirement account of any sort. Their assets is a brand new car and a new house. And they wonder why they're struggling, and at 40, why they're upside down and why they have so much debt. And it's because they just never were taught, they never played Monopoly, apparently, just like, hey, you got to land on a property that you rent out to somebody else. You gotta rent out your asset. You got to generate income off of it. Otherwise, you're going to be working your entire life. Yeah.
One of the best games ever, game of Monopoly, so.
Hey, a fun one, Gary, is if you ever look at the rules, it says if the bank ever runs out of money, what do? Pieces of paper, and they start writing numbers on it saying that'll be our cash. It's pretty darn accurate as we are right now. As the printers, I can hear them running as they're printing out more and more cash.
And you can just see. I mean, and I'm a very positive person, believe me. But the government has already printed a lot of money in the last couple of years, mainly in relation to the virus, but they went too far, and now we've got you've got some major factors. You've got really high inflation, and they'll say, well, it went from, we thought it was 5.4, but now we're saying it's 7 something, and they show you what we call the bread basket, which includes shaving cream, eggs, milk, meat, gasoline, and they'll order it from top to bottom, most expensive, least expensive. But what they fail to tell you is they're just giving you an average of 7%. That's really not what's happening here. If you look at the shaving cream, you and I may only purchase shaving cream once every quarter, every 90 days. It's only $3 and it only went up 2%, right? But if you look at the top was gasoline, we buy gasoline probably every week at least, and it's gone up probably 75%. So if you think about the weighting of it, you have to provide a weighting factor of those different commodities. Some people are probably in the 35% inflation bracket, not 7%. So you got that, rising interest rates. Now you got this whole mess in, Eastern Europe with Ukraine and Russia and all that. And historically, when you have 3 or 4, or in this case, probably 5 of those factors, when you factor in we're in a very hot, heated market, it's a mathematical certainty we're going to have a correction. And all these people that are in debt up to their eyeballs, it's unfortunately going to be a bumpy road, So what do the wealthy do? I mean, I know, like I always have a coach I'm working with myself personally, but how do wealthy folks get around that? How do these use coaches and folks like you too and other mentors to skyrocket their income and net worth, really almost in spite of what the market's doing,
Yeah, so I think it was Warren Buffett that once said that interest rates are to the economy as gravity is to matter, right? And we haven't had a lot of gravity in the market, and as these things start to rise, as inflation pushes up, because we have so many people chasing so few goods, and right now we're at our highest savings rate ever in our history. Like, you look at it and it's just ridiculous because of the pandemic. They threw so much cash out there. Yeah. The savings rates are off the charts. There's no inventory for real estate. So that's driving it up. Lots of people trying to buy, driven up, really low interest rates. Again, more and more people in the affordability factor are chasing after these things. You have supply chain issues. So you have lots of people chasing fewer goods. So you have this massive inflation. And the only way you can combat it is by rising interest rates. So we haven't had any gravity in the economy in years, especially in the last 2 years. It's just been ridiculous. And so you see companies that are able to, like, let's say we're doing a high jumper and you were a great high jumper, but now there's no gravity. So you have a whole bunch of people that ordinarily wouldn't be great high jumpers who are able to clear the bar because there's no gravity. As soon as you put gravity on it, those folks will be held down. So I always say, like, you want to have folks that are impervious to that. And the companies and the people that are impervious to that are those without all the debt. Yeah. So if you have a fixed debt that's a really low interest rate, that's fine. But if you're forced to live off of debt, so you're a company that is not profitable, for example, a growth stocks, you're going to see those guys get forced back down to earth and they're going to get smushed. The companies that are profitable regardless, and they're sitting on a ton of cash and they don't need the debt, those companies are going to continue to take off. So that's where I would be putting my money, is in solid, profitable companies. And it just happens to be the same companies that we always invest in, which is dividend producing companies that are profitable over a long period of time. And you put it into real estate. Real estate is still like the higher end, the folks that need debt to get properties. You're going to see that get pushed down a little bit, but we're completely underbuilt. Since there's been no gravity, people have been building houses for folks that are in a higher income bracket. So you see lots and lots of properties being built for people making over $75,000. You have very few properties being built for people making less than $75,000 because there wasn't this barrier to getting money. Once that barrier is put back up, well, we're dealing with about a 3.5 million, and this is according to the Harvard Joint Center for Housing. We are a good 3 to 4 million units underbuilt in this country. Wow. For regular folks. So where would I be focusing? Single family. I'd be looking at shared housing. I'd be looking at any solution to address the shortfall for those folks that are making underneath, let's say, $75,000 a year. That's where I'd be really, and that's what I see with my clients. That's what I see with my higher end folks. They're going into multifamily. They're going into anything that is surrounding assets that are impervious to inflation. And just remember, inflation and growth are what drive up securities. Inflation and growth are what drive up real estate. And so that's where I'd be going.
Yeah, I agree. It's we're one of the things we're really excited about right now is corporate housing. It's like it's
huge.
It's not traditional rentals with a family with 3 kids and 2 dogs, an annual lease, but it's also not the short-term like Airbnb vacation rentals. It's in between it. It's a fast-growing market. Hi, Gary here. Just want to say thanks real quick for listening to the podcast. We really appreciate you doing that. And all I want to do is take a quick minute to introduce you to the Healing House Foundation. Okay, so if you're watching this on video, I'm going to let you see it. If you're on podcast, you're not going to be able to see it, but you can see it in the click on the show notes on globalinvestoragent.com, and you can see, well, that's the main website, globalinvestoragent.com. This is a great place for you to connect, not just with me, but with all the agents we have around the country, and check it out. But more importantly, if you click on the Healing House Foundation, okay, you can read all about it. And this is a 501(c), totally voluntary. Nobody here makes a dime. So all the proceeds, 100%, go to local needs in your area where you live for people that need help, all walks of life. I mean, every one of us knows somebody that needs help. And this is our way to come back full circle in the world of real estate where we make so much money. Let's help those who are in need. Sometimes they need a helping hand. Sometimes they need to be taught how to fish, and sometimes they just need to fish. Sometimes they need both. So this is a way for you to participate. Check it out. All kinds of stories, examples. It's very flexible in that we can earmark funds for a particular need that you have in your area, as long as it's related to the need of housing. That's all. It doesn't matter what the underlying circumstances are. We pray for healing for everybody. So, in any case, thanks for indulging me. Let's get back to the podcast.
Out here, it's massive. I live in Las Vegas, so I can look at the casinos over my left shoulder, and I can look at Red Rock in front of me. And there's just no housing. Right. We shot up, 40% last year. I just looked at a study of the hottest markets. We were in 50% growth, according to the one that came out yesterday. And I'm like, okay, where are you finding any housing? Well, think about the companies that have to house their folks. Yes, they could go to a hotel, but no, if somebody's coming out here for 3 months to do a job, a lot of the corporations have folks that are coming out here 6 months, and hospitality, they're rotating. A lot of the traveling nurses and things like that, they're out here for months. You want a furnished unit, and there's no way you can't even get a rental around here. It's gone like that. There's just no housing. Yeah. So yeah, it's a great market out here for sure. But you're seeing this stuff get pushed up, and again, it goes back to the investor mindset: is I need to have cash flow. I need to be getting returned money on my investment. Right. It's kind of hard to do it out here unless you're willing to think outside the box. And I call it shared housing. Quite often, corporate housing is a great one. You're seeing companies like they just shot out in the last couple of years, but Pad Split and some of these they're a great company. If you ever want to talk to those folks, they're just amazing. Yep. But it's like Airbnb for rentals, but it's by the week, it's by the month type thing. But you're seeing more and more of these innovative kind of investor-driven resources. Yep. That are going to be, I think they're going to be prominent over the next few years. Just keep your eye on it, because there's no housing for regular folks. Like, it is a 1-bedroom apartment out here is over $1,000 a month. And you cannot, if you're making $15-20 an hour, you cannot afford to do that. So you're having to do something that is a little more creative. Yeah, I agree 100%. I remember my very first property I bought was January 1986 in Virginia Beach, Virginia. It was a 4-bedroom, 2-bathroom ranch, $63,000. Yep. Now that house is easily, between 450 and 500,000. It's not even, it's miles from the ocean. I mean, probably a 5-minute drive. And the moral of the story is people always ask me, well, should I wait? Should I wait for prices to go down? I'm like, wow, man, I don't know, because we have such a shortage. I can see a recession coming. That's a given. But housing prices, I don't think they're going to go down this time. I could be wrong. I don't have a crystal ball. I look at there's actually a really interesting chart. I kind of built it, but it's easy to get the data. You go to the Federal Reserve, the St. Louis Federal Reserve. So the Federal Reserve economic data, Fred, just type in Fred and data and you'll find it. But you can look at the average cost of a house and then the average rental cost of a house. In other words, they look at the value of the house in the form of a rental, and you compare them. And in 2005, they went wonky, right? People were overpaying for houses. The rentals wouldn't support it. And you actually see it peak right around 2006. Mm-hmm. And you could see that was about to turn over. And it's like, okay, people are overpaying for properties and the rents do not justify the expense of those homes. Right. That's not happening right now. What we're seeing now is we're underbuilt. We have not been keeping up with the demand. We've been building on the higher end because, again, there's been really cheap money. So you could do it as opposed to servicing the folks that are making $50,000 a year. We've been servicing the folks making $100,000 a year. So a lot more high-end housing. And because money's cheap, that's getting gobbled up. There's no inventory. Mm-hmm. Like there's literally a lack of housing in many, many jurisdictions. So what's going to happen to the real estate market? I would still be investing. I still invest in real estate. I'm not going to stop.
Right.
The other thing is if you have cash flow properties, so you're buying assets. And to me, again, an asset, something that puts money in my pocket. That's if it puts money in my pocket after my expenses, after my debt service, it's an asset. If you're still buying assets, there's no bad time to buy. Right. It's really because I was in Vegas when the economy turned in 2008. I still remember houses losing 75% of their value. Yeah. You know what didn't drop 75%? Rents. Rents went up. Rents consistently went up. And so we just never sold anything. We never really intend to sell anything. We always say the best strategy I could tell you for investing is buy really good companies every month. Just start buying them. Don't try to time the market. Just start buying good companies that are producing income, but put it on automatic. Like, hey, it's going to invest every month in these things. And then lose your password for 20 years. Just lose it. Don't look at your account and you'll be shocked at how great you're doing after 20 years. Same thing with real estate. Buy it. Don't sit there and mess around like, oh, should I sell it? Should I do this, that, or the other? Just let it produce the rents. Let it continue to grow. Yep. Reinvest that money as it snowballs and quit trying to time the markets and quit trying to be super, super smart. At the end of the day, it's finding good companies, good properties, and then waiting. After 20 years, you're going to look like a genius no matter what.
Yeah. Yeah. Well, let's do this. I know we're going to get short on time, but a couple of things I want to cover is when reading about you, and I know you've got a great book out there, Infinity Investing. Would you mind describing to people the 5 infinity sources of passive income?
Yeah, it's really easy. It's rents, royalties, dividends, interest, and short-term capital gains. And I'll go over a couple that your reader or your listeners are just going to go to immediately, right? Rents, you buy things, you rent them out. That is a passive source of income in my book. It's also for the IRS. That's actually one of the passive sources. It's not portfolio income. It's something that whether you're sleeping, whether you're going to Fiji, whether you're goofing off and doing a round the world tour, is still coming in. That's what those infinity income sources are all about. The other ones that I've really focused in on are dividends. And the reason I focus on dividends is really twofold, because one, dividends tend to increase. So we buy companies that have been increasing their dividends a minimum of 10 years. We like 25 years to 50 years. So like Coca-Cola has been increasing its dividend for 56, 57 years. Every year that dividend goes up. So every year you get a raise. Every year, it doesn't matter. You're getting more money.
Right.
And you don't have to do anything for it. And dividends are taxed as long-term capital gains, which means that for some people, if you're married, for example, and you're making less than $80,000 a year, it's at a 0% tax rate. So we're like, we like that. We love dividends. And then if you're renting out your stock, that's called short-term capital gains. So if I sell options on my stock, and I could do that weekly, I could do it monthly, I could do it yearly. Mm-hmm. That's free money that comes back to you, that's short-term capital gains. But the moral of the story is you're not doing anything to have to work for it. You could be on a yacht. You could be out hiking. You could be sitting at home in your pajamas. It doesn't matter. That money's still coming in. You could be traveling. You could be going and seeing your kids. You could be doing whatever you want. Yeah. And you still have income being produced. And the most important factor is we're not rating our principal. We're not selling anything. We're not selling anything as far as the asset, the underlying asset. We are selling calls if we're selling a covered call, but that's it. We're not doing anything risky. We're not buying options. We're not doing any of these things that the gurus out there are going to mislead you on. You're doing bread and butter, what the wealthy do consistently over time. And how do I know? Because I have a whole bunch of wealthy clients that I do taxes for. We have over 10,000 returns a year. We can see who makes money consistently. We've been doing this for 25 years. I don't have to guess. Most of the gurus are full of, you know what? Yeah. If they actually had the returns that they were saying, they wouldn't be selling you a system on TV, right? They wouldn't be selling you constantly like, hey, you got to buy this. You would actually be breaking down the door to come to them.
Yeah. Yeah. So that's we got so far through rents, dividends, and selling options on your stocks,
Yeah.
right?
Yeah, and the others is royalties. If you write
Well,
things, you could buy oil rights and things like that. And then interest is loaning. But I look at those kind of as, they're not my favorites. But if
yeah,
it's no problem to have interest being generated let's say that you have Bitcoin, or you're into crypto and you stake it, or you're loaning it out and you're allowing it to be used and they're paying you an interest. That's still passive. You're not sweat of your brow doing anything.
right.
But those are the infinity income sources. And here's how I use it, Gary. So it actually makes sense.
Mm-hmm.
Infinity means I don't have to go to work anymore. Infinity means I could live at an infinite period of time off of those 5 income sources. It's not my W-2. It's not my job. Exclude those and ask yourself, how many days could I live without working? And if you want to, we have a calculator on our website. It's infinityinvesting.com. It's really simple. By the way, it's a free membership. Believe it or not, we love helping people make money because I'm an asset protection attorney and a legacy planner and a tax guy and asset protection guy, right? Like, I want you to grow your hair so I can cut it. If I was a barber, I'm giving you hair cream.
Yeah.
The whole idea is that you take and figure out your expenses per month. And then with those 5 infinity sources, what it takes to replace those. Because otherwise you're spending down your principal. And I don't want anybody spending down their principal, because like in Vegas, the property values dropped 75% in 1 year. Like, literally we were the foreclosure capital of the world.
Right.
Guess who wasn't foreclosed on? People that had assets, didn't have a ton of debt. Their rents never got hurt. They continued to make money, period, because they weren't forced to sell. Who got hurt? The person that had to sell because they had a liability that they were trying to pay off another liability with. Right. And that's what we try to avoid. If you have the 5 sources of infinity income coming in that cover all your expenses, you never have to sell anything and you never have to work again. It doesn't mean that you don't work again. It just means that you don't have to, which is actually a really nice place to be.
Yeah. Yeah, I agree. It's something you mentioned a little while ago. I want to just revisit briefly for everybody listening. This is almost counterintuitive, but if you think about it, when a recession occurs, fewer people are buying homes typically. So they become renters, and the stock of rentable properties is relatively fixed. Of course, builders can keep building more, but it's not like you snap your fingers and more properties are out there. So when you have more demand and supply, it drives up the value of that, which means the rents go up. So when you have decent properties, you'll generally see rent increases in a recession. I know it sounds counterintuitive, but that's exactly what happened to me. And I love the royalty part, because I realized when I wrote my first book that has it's intellectual property, has intellectual property values, intellectual capital. And so just to give you, for everybody listening briefly here, the company that I'm speaking for actually pays me to use my name, my image, and the use of my intellectual property, and I get paid in the form of royalties. Perfectly legit, legal, everything under the sun, done correctly, and it's a less taxed form of income. So in any case, great advisor. So we got. I was taking notes so I could remember. Let's make sure: rents, dividends, selling options on your stocks, royalties, and interest, because that's the 5 things. And also remember the infinityinvesting.com. And if you wouldn't mind, Toby, maybe a final word of wisdom for everybody, because I know we're going over, but I want to make sure also, in addition to the website, there's anything else you can share or want to share with them for them to be able to connect with you, because you've got some talent, some skills, and of course you're a tax attorney, and among what's always been an investor. That's I think you're going to make a lot of friends out of this. So,
well, here's what I would say:
yeah.
It's really hard to get through the noise out there. There's a lot of bad information, and it's usually the people that have the big pockets, because they're making so much money off of selling the bad information, getting people to buy the wrong type of investments, things that hurt them. So what I would say is, we are a group. infinityinvesting.com is absolutely free to come in on our basic side. There is a paid area, especially if you're looking for cash flow properties. But if you're a realtor or you're somebody who has access to cash flow properties and you have good deals, by all means, please come on in, become a member, and then let us know that you have it, because we are a community. We're not sitting here trying to make a buck off you. What we're trying to do is bring good investments into our community. It's a very, very interesting way of looking at it. People always say, why are you doing it? Because the companies I work with, quite often the property managers, quite often they're other investors, and they actually believe in people being able to be prosperous instead of just hosing them over. Unfortunately, the folks that are out there the loudest, like the Kramers of the world, you see him on TV and he's wrong more often than he's right. In fact, they have an inverse Kramer ETF that does the opposite of whatever he says, and it's up. You look at it and you just realize most of these people are out there just shilling something. Our community is so different, and we're looking for people that get it to come in and help. And, I'm not asking you guys to work. I'm asking you guys to bring in good deals, because once you understand that it's assets that we're looking for, there doesn't have to be a transaction on everything. It can be, hey, we're a community and we're trying to help out the community. Awesome.
Well, I really appreciate this, and I'm pretty sure I speak for a lot of people when I say that they appreciate it too. And for everyone listening, just remember the website, infinityinvesting.com. Become a member. It's free. You got nothing to lose and you got lots to gain. So I'd definitely take advantage of it. And for all you agents out there, the agents who want to work with investors, jump on there too, because that's where investors are. And while you're at it, go check out globalinvestoragent.com. We got agents in 27 states, so you can carve out your own niche and basically not worry about the recession and work with these investors who are going to be making a lot more money coming down the road here. So go have at it, guys. In the meantime, take care of yourselves. God bless you and your families. And also, if you could, please leave a review for Toby's podcast interviews. This is what makes the podcast world go around. Leaving reviews helps everybody. If you don't pay for the podcast, so you can donate 10 seconds to leave a review, that will really be appreciated. Thank you very much, and we'll see you on the next podcast.
Thanks for listening to this episode of Massive Passive Cash Flow. Be sure to go to realestatewithgarywilson.com to join our community and start building wealth today.